What's happening, everybody? It's the Flow Show. I'm Sean McLaughlin. He's Steve Straza. Straza, before we get to any trades, everybody wants to know, you're in Florida. Do you give a shit about Game 7 tonight?
Oh, so much. Yeah, Florida people got really excited. I think we pre-celebrated in a way.
Yeah,
Yeah.
I think you did. I think you guys are choke city right now. Edmonton, man, they look like they're gonna pull it out.
No, to be honest, Sean, and I've loved it because playoff hockey's great because I mean just there's just so much passion on the ice, right? Like they're fighting, they're going crazy about it. So I do like it. I would have loved to go to a game too.
Well, you
And
got a chance tonight. I mean, I'm sure that ticket will be real cheap.
they're not bad. I did look, and I'm used to paying for Rangers hockey games at Madison Square Garden. It was not like that. We could have gotten into the arena for like $200
Wow.
in the series. So
Well, I know you're rooting for the Panthers. I'm rooting for the Oilers just because, the Canadian in me wants to see that happen.
I mean, Canada should beat Miami in hockey, right?
Well, and also, how cool would it be? It'd be the first time since 1942 that a team has come back from down 3-0 to win the series. That's pretty cool.
Really? Yeah, but that
Yeah.
would be embarrassing on the side of the Panthers.
Yeah, it would be. And more embarrassing for that Panthers coach. That guy I think he's got the most playoff wins in history without winning the Stanley Cup.
Yeah.
Like that dude, I mean, man. All right. People aren't here for our hockey talk. We're here to talk about options trades. So what we do here in the Flow Show, if this is your first time tuning in, me and Straza work through our process to find some options trades. We usually find an options trade. We don't always find an options trade, but what we do is Straza throws some charts at me that he likes, maybe bullish chart, maybe a bearish chart, maybe both. And then we'll look to see if there's a good options trade we could put on. So with that intro, Straza's excited. He's got a few charts he wants to show me today. So what do you got, buddy?
I'm excited, Sean, because I'm always trying to make you happy. Okay.
Oh,
In the show. Like I want to bring you, it's my job to bring you setups that you like. I want to make you excited about these charts.
oh man. Yeah, I wish you would talk to my wife and share that idea with my wife. Anyway.
So listen, remember semiconductors. This is the great semiconductor bull market, right? And
Yeah.
these things have been great off the April lows and rolling over a little bit here now. Okay. Rotation. Rotation is the lifeblood of a bull market. So I think, what are some other leadership groups that we can look to now that may be ready to, reassert their old leadership? When I think of the best groups this entire cycle, it's semiconductors and then it's home builders. I like to use the XHB. ITB works as well. The point is, this trend off of the 2022 lows has been so strong. And there have been some really nasty corrective waves along the way. For example, last summer into the fall, it almost looked like this trade was over. We're in an 18.5% drawdown at the index level. And then we just fire off the lows. And, if you were able to enter somewhere along the way, it was 60% up move into the Q1 highs here. So I think this group has gone sideways for too long, and it's only a matter of time before it starts to look a lot more like the semiconductor indexes. If you anchor a VWAP from these March highs, we're right there. And I think you'll like this. The two, I guess, industry leaders, probably some of the more liquid ones also, because these are just like the biggest by market cap. Let me confirm that. Yeah, it's Lennar and DR Horton. Both of them have earnings out of the way.
Nice.
In
You
the case
know,
of Lennar, they
I
just had it last week. So
I like this pond that you're fishing in here because I don't have any home builder exposure here. So you've already got my attention. This is good.
I think and then just like this is how you want a correction in an uptrend to look. Let me explain. So this is Lennar. Like I said, they just had earnings last week. It was pretty muted reaction. We're still trading around the same old level that we were then. But this corrective action, you could see it in the momentum in the lower pane here. This is the daily RSI 14. It's come out of overbought territory, hasn't been overbought all year, but also nowhere's near oversold, right? There's not much selling pressure because this is still a leadership group. Now we just need to figure out, how do we get in? Like, how do we get involved? Where are our levels? And I think with like DR Horton, you could see it cleaner here, right? Like I talked about this one on the morning show this morning, but Sean, this is going to be a failed top, right? That's the bet that we would want to
Oh,
make.
is this the one you showed that scary head and shoulders chart on? You're trying
Yeah,
to scare people?
I did like 3 arches here. That's what Sean's about, right? Because it does. That pattern scares people. You see the 200-day rising meeting price, right? Like we've held this level all year over and over and over again. So I don't like, what option strategy do you think lends itself best to the potential non-top?
Well, before I answer that question, are you able to real quickly put together a little relative strength comparison between these two, like which one's outperforming the other? Because that's where I would lean, because both these charts are pretty similar.
I've
And
already
so
done it.
that being the case, I would prefer to take the one with the higher relative strength.
So you want DR Horton, I think.
DR Horton. Okay.
So they're pretty, like, look at this. They're going to go in the same direction at the same time, right? One might be a little bit better, but when you see something this tight, like this range is nothing. So while it looks like this chart might have moved a lot, we're talking about typically an immaterial difference. However, over the short term, there could be large divergences. So we always want to be the best one. When you zoom out enough, look at DR Horton. Structurally, it's the better one. And then we just have this big range. And this is DR Horton in the numerator, Lennar in the denominator, right? We've sold off. So it's favored Lennar all year while we've been correcting. If we make the bet that these stocks start working again, while they're going up, DR Horton tends to be the one that's outperforming. So I think you do want DR Horton. And you could draw this like this too, Sean. Ready? Just like the failed top on absolute terms. You could draw the relative trend, something like this, and say, oh, look, nice little scoop and score here. Oops, right? Firing higher. That's
all right. Here, this presents an interesting situation here, and I like it. So you mentioned how Lennar just had earnings. They just got earnings out of the way. DR Horton has not had earnings yet. They come up in a few weeks. But knowing that these two stocks, these two companies are pretty correlated, they work in the same sector, they're affected by the same macro headwinds. Knowing that the Lennar earnings reaction was pretty muted, that makes me think that, DR Horton would have to come up with something shocking to really surprise the market.
Yeah.
I'm betting that's not going to happen. Right. So the options volatility in DHI right now is actually pretty elevated, probably because of the earnings event coming up. And my hunch, knowing what we know about what happened with Lennar, tells me that maybe these options premiums are a little overpriced. So let's take advantage of that, Straza. And you're going to love this because you've been wanting to talk about selling puts all the last couple of weeks. I think the way to play this is our old friend, the risk reversal. Little sell some puts, little buy some calls.
All right.
I think that's the move.
I walked you right into it. I was hoping you would say that. I was preparing myself to be disappointed again. But yes, the risk reversal, because we're betting this fails, we dig in here and rebound. And now I have a question for you. When you do the risk reversal, why not sell the puts at an earlier expiration, right? Get more juice from it. We know we're coming off that level, but then go like an extra month out on the calls. Is that crazy? Because you want to give the calls more time to work. You could cover the puts when you rebound off the level. You cover the puts, help them finance the calls, right? But then do we actually get a leg up and higher out of here? There's still work to do, right? Like we need to reclaim this VWAP. Like I would rather the calls had more time. Is there a way to do that?
Sure, you could do that, but you're just going to pay more, right? Because what's going to happen is if you're like, we're in June right now. So if I were selling puts, I would probably sell August puts, right? Let's say, and I'm just I haven't looked at the chain yet, but let's say I sell an August put and buy a October call. That October call is going to cost a lot more. All the put in this case is going to do is just reduce the cost of the call, which is nothing wrong with that, Straza. That's a perfectly fine thing to do. I just generally, when I'm doing a risk reversal, I want the put to completely pay for the call. And generally, the only way you can make that happen is by using the same expirations.
So here's where my mind goes with the puts. If you go, like, say that month further out, you collect more, right? But if you keep it close, so in something like this, DR Horton, say you do like the July 19 puts, while you'll collect less initially, if this neckline holds, right, that theta starts to work and they get a lot cheaper faster. And you could actually cover those positions probably for maybe, I don't know, 40, 50% of what you paid faster than you would if they were further out in expiry. Am I right to think that way?
For sure. They will depreciate faster, but again, you're not getting as much, right? So like let's use some real numbers here.
Got it.
Let's look at the July expiration, which has 25 days expiration. I don't think we want to sell the 145s, do we? Maybe like the 140s.
140 neckline,
Yeah.
right? Like
Right.
that's breakdown level. Maybe if you want to talk about that's technically 139, but right, we want to set the put strike at our level now.
So if we sold the July 140 puts right now, we'd probably get about 270 for them. Okay. Now, remember that number, 270.
Yeah.
Now, if we want to buy some calls with more time, let's say November, because it's either August or January.
Yeah, November sounds right.
Yeah. So if we were to buy November, like if we bought like the 25 Delta calls, which is the 170 strike.
Yeah, you got a net debit there then.
Yeah, those are gonna cost us 375. So look, again, nothing wrong with that. That just means you got the calls. You're buying the calls and you're just reducing your cost with the short-term puts, which I don't hate that, Straz. In fact, we did a trade just like that on Friday in GE, right? I bought some calls. I really just wanted to buy the calls, but I'm like, I'm going to sell a put spread against it and another that, Straz. And I don't hate that. In fact, owning the November 170 call for basically $1. Yeah. You know, why not? It just means we got to be a little bit tighter with our risk management, right? We got to like 140. If we break below 140, we definitely want to get out, which we probably want to get out anyway, no matter what position we put on, right?
With a pattern like this, we have a tiny bit of short-term momentum, right? Getting a nice candle today. If this even reverses and heads back towards that neckline, it's probably a bad sign, right?
Yep.
Even if it starts in that direction. So I don't even think you have to wait for 139. I think you keep it 140 or tighter. We're at 145 and change right now.
Yep.
Is that too much though? What does this trade look like $5 lower? Those puts.
So, okay, that's a good question. Gene, if you want to flip to my screen real quick, because I'm showing the options chain here. All we can do is estimate, right?
Yeah.
But looking at the July 140 puts right now, I've got them highlighted on my screen. If we were to hit the bid, we would sell them for 265, right? We could probably get 270 for them. Now, Straz is asking if DHI rolls over and if it trades below what was the price? 139 you were saying?
Say 140.
Let's just say 140.
How much do we have to pay to cover these things?
So all we can do is estimate. And right now, with DHI trading at 145, if you look at the 145 puts, they're trading at about 460. So this is rough, dirty math. And of course, it depends on the timing. But if it happened tomorrow,
okay,
we could guess that these 140 puts will be trading for about 460, which is $2 higher than what we sold them for today. Not a terrible loss. We can survive that.
So that's the big trick. If you want to know what your options are worth at a certain price, you just look at the money contracts.
Well, again, yeah, I mean, because if DHI trades the 140, that means our 140 puts would be at the money, right? And right now, the at the money puts trading for 460. Now, again, this is an estimate because it depends on how soon this happens. If this happens tomorrow, this estimate probably holds. If it happens 3 weeks from now, maybe not, because these options are getting much closer to expiration. But also keep in mind too, Straz, that if we trade down to 140 quickly, you are also going to see a likely bump in volatility, which will add additional premium to these puts. So we can only estimate, but I wouldn't be surprised if it added an additional 50 cents to the value of those puts if we sold down to 140 very quickly.
You know, when we go too deep into the options pricing stuff, I start to have PTSD about business school.
Yeah, no, I hear you. But look, I'm coming around to your idea. When my first thought was risk reversal, and I was thinking traditional risk reversal where I sell the put and the call on the same expiration, but I kind of like this idea of selling the July 140s because we can get 270 for them. And if those November 170 calls cost us 425, I mean, no, they cost us 530.
Yeah.
I mean, we're basically getting the 170 calls at a cheaper price. Hold on, let me do that math again. Oh, no, I'm sorry.
Oh, we
That's
did
why.
November though, weren't we?
Yeah,
Doing
yeah. I'm confused. I was just like, why don't I don't remember the prices being like that? Yeah, here we go. The
this?
November 170s we can get for about let's call it 370,
Yeah,
and sell the Julys for
a
270.
dollar debit.
Yeah, I like that. And again, I like it because whether we sell the July puts or the November puts, either way, if we get to 140, we want out.
Yeah. No, this is fun. And as we continue to document my journey through learning to sell premium, I have more questions than answers. You have the answers. But the way I think about it is, from my account, I don't want all my margin tied up because I'm selling puts, particularly in high price stocks. 140 is not a low price stock, right? So the quicker I can get them to finance those calls and then cover them. If I cover them for 40 cents on the dollar, great. But if I could do that in a week instead of a month, even better, because then I'm not sucking up my margin. So
that's a very good point. That's a very good point. And for those of you who like doing a trade like this, and you do have margin concerns, either because you have a small account, or you just have a whole bunch of positions on and you don't have a whole lot of buying power, or you just are uncomfortable with unlimited risk, you could turn this into a put spread where you could sell those 140 puts and then maybe buy the 130 puts to protect yourself and define your risk a little bit and lower the margin requirement. Obviously, you'll get less of a credit for your put trade than me and Straza would by selling the naked puts. But there's benefits to that. It's not necessarily a bad thing. No. And that's the thing about options that I think that throws people off who maybe are new to options trading, is that there's never a perfect answer, right? There are all kinds of different trades we could do. One isn't necessarily better than the other. It really just comes down to how comfortable are you with risk and how much risk are you willing to hold? Yep. And how much do you want to manage your position? That's the other thing too. Options trades aren't generally just a set it and forget it type of trade. You want to, review them and maybe make adjustments, maybe close one leg of a spread. They're living, breathing organisms that need attention throughout their lifespan.
And it depends on the way the price chart changes, right? Like you'll want to do different things depending on the path of price after you initially put on the trade. A new trade or a new kind of addition to an existing position can pop into your mind because of what price does now.
Yeah. So I think really the takeaway here for anyone watching this is that really what we want to do here is we want to be owners of the November 170 calls. And any way we can go about reducing the cost of those calls,
right,
will benefit us. Yes, if we sell puts, either a naked put or a put spread, that adds some downside risk a little bit. But we have a very clear level that we want to get out. Below 140, we don't like this trade.
Short puts below 140.
Right. If we're below 140, you don't want to be naked short puts. Absolutely not. All right. I see a bunch of comments came in the chat. Let me just review, see if there's any good questions here that we could talk. Someone says, I cannot resist the handsome options show. Wow. They must be watching somebody else.
That is a great compliment. Thank you, whoever said that.
All right, cool. Just people responding that they like our little process here. Great. All right. So that's what we're doing. We want to be long the DHI 170 calls. I mean, that alone by itself is an okay trade. The implied volatility is a little high now, so you're paying up for that. So just be mindful. If you were to do that, you're a little bit swimming upstream. Doesn't mean you can't win, just means it's harder to win. But if you sell some puts against it and lower your cost, maybe even I'll sell some calls. I got to look into a little bit more stress. I might even sell some calls. I might do what I did with GE. We did a very complicated trade in GE last week, but hey, I do that.
Blew my mind. But I have ideas too. I'm going to call you from the car. I'm still thinking about this one, but I'm going to put this one on as soon as we get off. I like it. I like it.
Awesome.
I'll also say before we go, I just couldn't help myself. The regional banks, Sean, are interesting. That was going to be the other area that I looked at. I just think if we hold that support there, they could be a good put selling option as well right now.
I don't hate that. I do have a little bit of banking exposure in the portfolio right now, but not a lot. I got Bank of America on. That's it. I'm open to that. Hit me with some ideas for maybe later in the week.
Yeah. All right. We'll talk about it. Thanks.
All right, everybody. Thanks for tuning in. This has been the Flow Show. He's Steve Straza, about to go scuba diving. I'm Sean McLaughlin. We'll do this again next week. Until then, we'll see you on the morning show tomorrow. Take care, everybody.
Thank you.